Hello everyone, welcome to Just Invest Today. And today we are talking about Warren Buffett, the GOAT of investing. He turned 91 today, so we had to do a video on him. We have to understand how he became this successful. So today we're going to talk about his early partnership in the market and how he got these huge returns. Guys, we have to realize what Warren Buffett did and what he did differently than everyone else, and how his whole investment strategy kind of changed over the time. So we have to look at what he did before he got famous, before he kind of switched his strategy when he got a lot of money where he couldn't do the same things. Because we want to implement some of that into our investment philosophy, because we don't have as much money as Warren Buffett. So we can still do what he did in the earlier days, but we can kind of switch it up ourselves. So we're gonna go into it and find out what he did. So let's get into it. Can you like this video, subscribe to my channel? I'm on the road to 1,000 subscribers. Can you help me out? Thank you. I'm gonna provide so much good content for you guys, man. So in 1954, Warren Buffett had $100,000 with 7 limited partners. So that's where he got his start, and he went to different people to get his money, right? So as soon as he got his start, if you invested $10,000 with Warren Buffett in 1957, and then in 1969, you would have $260,000. In 12 years, you would have compounded at 31% annually. And you gotta think about this too. This was during times where there was a lot of down years. He never missed, he always had an up year. There was so many times in the market where there was down years, the market was down 7%, 15%, it didn't matter. Warren Buffett still came up on top and was still generating returns in that 12-year time period before he actually closed down his fund, and he couldn't find any more investment opportunities, so he closed down his fund. He couldn't take anymore. He's just saying, I don't have this anymore, I don't like what's going on in the market, and he gave all his money back to all his limited partners. And at the end of that, he had already $100 million. So you see how successful Warren Buffett was. And you got to think about it too. He was all about fundamentals. He didn't care about the hot stocks, the hot stories. He didn't care about, if we think about stocks today, like Tesla, like GME, he didn't care about any of the stocks. He just stick to what he knew. He did it very simple. He said he's 18% Phil Fisher and 85% Graham, and this was during the time. And Phil Fisher was more like a fundamental, these were both fundamentalists. Phil Fisher was more about management, about customers, about relationships, just doing scuttlebutt work. And Graham was more about all the statistics, the assets, the cash, the market cap, and what was it trading on the market. So that's how Warren Buffett looked at investing in the early days. So investing is the best when it's business-like, and that's what he keeps saying. You have to buy these businesses like you're buying a whole business. You got to think of it like you're buying a whole business, and that's how he looked at it. For example, he did Western Insurance at the time. It was earning $16, and guess what? It was selling on the market for $16. So it was a no-brainer, and those were the opportunities he was finding back then. Think about American Express. What happened with the oil scandal? The stock dropped crazy. It was more like 40, 50%. The stock dropped. He did his scuttlebutt research. He talked to competitors. He went into the steakhouse to see, are people still using American Express? If yes, then he bought the stock. He said that it wouldn't have bankrupt American Express, and he bought the stock during those times. And that's the kind of analysis Warren Buffett does. He makes sure he understands the concept of Mr. Market. It's probably one of the most important things he has ingrained in his head. And if you don't know about Mr. Market is there to serve you, not guide you on your investments. So in the short term, it's gonna be all like a voting machine. You don't know what the market's gonna do, what's gonna happen. But if you understand the business and you're willing to go long term, the fundamentals at the end, in the long run, it's gonna matter, and it's gonna re-rate into that multiple. So all he was doing at that time was buying dollar bills for 60 cents. And that was his main strategy, finding these dollar bills for 60 cents, right? And the thing is, back then, when that happened, when he was able to buy for 60 cents, he didn't really care when it was going to happen. He knew it was going to re-rate to that dollar, and he was just going to stand pat and make sure when it re-rates, he was going to sell out of it right when it got to that $1. Sometimes the stocks, even if he sold, would even go up higher than that. He didn't care. And I think that's why he was so successful, and his performance never went below, never went negative during that time, because he almost always had money on the side. Because as soon as the stocks exploded, got to that dollar price, he would sell out of it. So he had all that cash on the side to find another business selling for 60 cents, but even though it was $1. So just looking at strategies like that, that's what Warren Buffett did. Warren Buffett was all about fundamentals. That's all he cared about. He didn't care about the earnings reports quarter after quarter, the EPS. He didn't care about these amazing stories. He just bought very simple companies, insurance companies, banks, just very simple companies that he understood. And then he just rode those companies until it went back to $1 when he bought it for 60 cents and he sold off. And then he continued looking for more. And all he did was look in the Moody's manuals. He looked at financial reports and just general publications, just newsprint, just stuff like that. It was very simple back then. He gained 31% annually. Warren Buffett only had 4 rules to investing. Look at stocks as businesses. Very simple, because when you do this, you actually want to be, you feel like an owner. You feel like you're going to hold the stock for a long time. When you just look at stocks as a business, you don't look at stocks as just, it goes up and down and sideways. You don't look at it like that. 2, you look at market fluctuations as a benefit, not a negative. And when you see market fluctuations, you have to be glad when the market drops you 50% in the market. Those are perfect opportunities to buy sound companies. So that's how you have to look at it. And when the stocks go up, that doesn't always mean it's a good thing, because if you have money coming in and you want to buy it, you want to buy it at a lower price, not when it goes up, unless you're trying to sell it in the near future. Then you want your stock to be up at a high price so you can sell it off. But if we're holding 5 to 10 years, it doesn't matter where it's at the moment, right? So that's how the new Warren Buffett strategy is. But before, he did just sell the stocks when it re-rated to $1. The 3rd rule, you look for these businesses with a competitive, durable advantage. And that's all about moats. We have to find companies with moats. It's so key to investing. That's how we're going to be able to hold these companies for a long time, when they have durable moats. And then lastly, we have to be able to see if this company is still going to be around 5-10 years from now. Just answer that simple question. When you buy a business, just answer that question. Do you think this company will be here 5-10 years from now? Think about that question, and think about it carefully, because when you think about that question, that just shows you that the company is durable. The company has a competitive advantage. If you can answer that question very quickly, just ask that yourself that. Think about Google. Will Google be here 5 years from now? Yeah. Will Apple be here 5 years from now? Yeah. Very quick answers. Let's think about more companies. Will Wish be here 10 years from now? We don't know. Will Zoom be here 5-10 years from now? Can you say that with confidence? I don't know. And that's how you have to think about these companies. And that's how Warren Buffett thought about these companies. So how am I going to implement this? I have 2 portfolios in my mind. In my head, I have the companies that I want to hold for 5 to 10 years. And those are the strong companies that I think are going to be successful, competitive advantage. They have durable moats. Then I have the other type of companies that I buy when I feel like the company is below its value and I can see it re-rating back to that $1. And that's when when it goes back to that $1, I sell off. So it's almost thinking like a net, but it's not a net, but that's how I'm thinking about it. So you buy a company that you think is worth way more, and then you sell it off when it gets back to that price. But I don't think about it in that long-term aspect, how I see the other companies on this side of the ball. So I'm using both of these strategies, because that's how Warren Buffett got that 31%. You buy for 60 cents on the dollar, when it gets back to that $1, you sell it off, you find a new company. So it's harder to do that now, but you can still do it. I've done it so many times. I did it with Skechers. You can look at my channel. Skechers. I did it with Foot Locker. I did it with Intel. What else did I do it with? I did it with so many different companies, man. So I did it with Ulta. See what I did? And I can even show you there. So that's the two different strategies I'm using. So we can use this in this Warren Buffett strategy. This is how we're going to get that huge gains, those 31% annual compounded for 12 years, which is amazing. Can you please subscribe to my channel, like this video, and I'll see you back in my next one. Peace!